That'd be great. Thank you. Oh, it's ready to go? All right. I just got the comment. Yeah, let's go ahead and get started. I'm going to go ahead and share my screen. So let me go ahead and do that now. Wasn't sure if you were ready for me yet or not, but let's go here. I'm going to get the comments out so that I can see that too. And then I'm going to share my screen. Okay. Does that look good? Just type into the chat or the comments. You can see my screen, reverse plus. All right. Well, let's go ahead and get started. Rock on. So thanks for having me back again this year. I miss you guys. As a personal note, 2 years ago, I moved to Pennsylvania. And so I live in an area that people call Happy Valley. The Valley's not very happy right now because Penn State's not undefeated. They're only happy in Happy Valley if Penn State's undefeated in football. But it's very cold up here, both the weather and unfortunately a lot of the people. So it's very different than being in the South. I was in Atlanta for 30 years, and so I miss being down there, but I will get back there. Just give me some time, and I'll be back to do this presentation live in future years. But a couple of things you need to know about what I'm doing right now is I teamed up with the smartest dude in the reverse mortgage industry. He's been from the very start, back in the late 80s, when Reagan passed the reverse mortgage bill. He's been writing software for the reverse mortgage industry for quite some time, and I've admired this guy for years. And so we teamed up to create a company called Reverse Plus. So you can see that on the screen. That's our logo. It's on my shirt as well. It's a fairly new company. So far, we've been focusing on 3 major initiatives in the reverse mortgage space. Number 1 is education, which of course I'm passionate about. Software, which he's been doing for years. And then, of course, we have an AI-driven knowledge base for the reverse mortgage space that nobody's ever had before. And so we're basically creating innovation within the reverse mortgage space. So what I'm going to do is I'm going to go through a quick presentation for you just to cover some of the basics, make sure we're all on the same page. And then I'm going to show you some case studies using our software. Feel free to type into the chat, and I'll try to keep an eye on that as well. But let's go ahead and get started with the first screen. So if you're not familiar with some of the presentations I've done in the past, the first thing you need to know is what is a reverse mortgage. And if that term, reverse mortgage, sends chills up your back, you're not alone. I was that guy too. I was a mortgage professional long before I ever got into the reverse mortgage space, and I advised people against it. They would come to me and say, Dan, can you help me with a reverse mortgage? And I said, no. Why? Well, because they smell bad. You know, something's wrong here with the reverse mortgage. I don't like it. But I didn't know why until I started really looking into it and studying the product and realizing this thing's fascinating. What an amazing product. And it crosses over into real estate, housing wealth, investments, insurance, financial planning, taxation, a lot of the things that you focus on, right? And so really, if we do this properly, 4 things should happen with a reverse mortgage. You should have more cash flow, more liquidity because of the guaranteed line of credit, lower taxes, and believe it or not, higher net worth if you do it right. Unfortunately, most people don't know enough about the product. They just start sucking up all their equity. And no, you need to use it strategically with the assistance of a professional like yourself. So what is it? What is a reverse mortgage? It's really nothing more than a loan secured by a home where repayment is deferred to a later date, usually after you've passed away, and the home sells. Now, the heirs can sell the home and receive their inheritance. That's generally what happens. We've had great home appreciation for the last 10 years. So most of our clients are actually gaining equity with a reverse mortgage. What causes them to lose equity is they consume it. Here's their equity, and they say, you know what, I need to draw more and more and more. Okay, it's not the reverse mortgage that erodes their home equity. It's the need for consumption in your retirement years. Now, this is a very broad definition of a reverse mortgage, but there are all kinds of reverse mortgages now. Some that even call themselves reverse mortgages that are not, and there's some lawsuits about that. Most of what I've been involved in is the HECM program. That's the home equity conversion mortgage. We'll talk about that in a moment. That allows me the opportunity to work with HUD and FHA and Ginnie Mae. But it could be a proprietary reverse mortgage, which we'll talk about here in a little bit. It could be a single purpose reverse mortgage, which is generally offered by a county, municipality, township, or community. But again, the vast majority of reverse mortgages in America are HECMs. That's slowly changing, but a HECM is a home equity conversion mortgage. It's the only federally insured reverse mortgage in America. It does have an age requirement. You got to be 62 and older to be a borrower. Now, you can be married to someone under 62. And until 2014, that made me very skittish. I did not like originating reverse mortgages when one spouse was underage. And yes, under 62 is underage in our business. All right, but since 2014, HUD has created a program where it protects non-borrowing spouses so that if the last borrower passes away, the non-borrowing spouse can remain in the home until their death or another maturity event. It does convert a percentage of their home's value into cash or a growing line of credit, which we're going to talk about today. This growing line of credit, which is fantastic. And of course, you can continue to own your home, but you got to live in it. There are occupancy requirements. Now, I know this is fairly basic for some of you, so I'm going to move rather quickly through this presentation. But when I got into the space, you guys remember the housing crash in 2008. Most of my clients were there at level one. They were house rich, cash poor, and they needed money, and they needed it yesterday. Today, most of our borrowers are at level 2 and level 3. Maybe a lifestyle enhancement would be, I want a new kitchen or a bathroom, or I want to buy an investment property, which we'll talk about. Maybe I need a new roof, or I want to travel to see the kids and grandkids, or travel to get away from the kids and grandkids, which is a problem when you're a retiree. Sometimes you wind up being a babysitter. So, put me on a boat somewhere, or, let me travel the world. And sometimes that's a lifestyle enhancement. And then number 3, this is where I've spent a lot of my time over the last few years, of course, working with Roger over the last 10, 11, 12 years, is there are a lot of financial planning implications, from Social Security filing decisions to how much should I draw from my 401k or IRA. We have portfolio management programs with reverse mortgages, sequence of returns risk. If you have a $300,000 line of credit, then why are you selling stocks at their lowest point during a bear market? So we have all kinds of ways that we can help facilitate some of the financial planning initiatives that I know some of you talk about. And taxation, of course. We're going to talk about that today. All right, some of the misconceptions, guys, and I know some of you probably have some of these. You've heard this all the time. If you present this to a client, the first thing they're going to say is, well, I don't want the bank to take my home. That's not how a reverse mortgage works. And even so-called experts on the TV and radio will say, well, it takes ownership of your home. No, it doesn't. Today's reverse mortgage does not take ownership of your home. And if it does, it's not a reverse mortgage. Okay, there are products out there called home equity agreements or home equity investments. No, those are not reverse mortgages. A reverse mortgage does not take ownership of your home. It's simply a lien. It's nothing more than a HELOC with an optional payment, right? No, it's not a last resort option. Now, I'm 56 now. Yes, I'm aging. And when I turn 62, I will get one. Not because I need it, but because I want it, because I know the financial planning implications. Number 3, do heirs get stuck with a bill? No, this is a non-recourse loan. So neither the borrower nor their estate can ever owe more than the home is worth at the time it's sold. Can you outlive a HECM? Nope. Nobody's ever done it. The default maturity date is age 150. They set it there because they figured nobody's ever going to get there. But HUD has told us if someone lives to age 150, they would service the loan on behalf of the lender. Are HECMs expensive? Well, compared to what? There's no other product like it. I would argue the benefits far outweigh the costs. Now, the costs are very typical for an FHA loan. So if you're used to traditional FHA lending, it's very similar because it has an upfront insurance component to it. And then lastly, we discussed this already, but do HECMs eat up home equity? No, consumption does. If a borrower has $300,000 in a line of credit and they need $50,000 for something and they draw it, that reduces your equity because you only need a little bit of home appreciation to outpace the interest accruals. So when people lose all their equity with a reverse mortgage, it's because they need money, right? In many cases, because they've run out of other sources. Okay, so moving on. We believe that facts matter at Reverse Plus, and so a lot of what we have is based on these two books. Of course, I know many of you have this. This is the 2025 edition of Understanding Reverse. It's the nuts and bolts of how a reverse mortgage functions. So our AI bots that we've created are based primarily on my books and the regs. And that's it. We don't go to the internet to get all the incorrect garbage that people say about reverse mortgages infiltrating our AI bots. And so you probably are unaware that I also published a sequel called Navigating Reverse. Navigating Reverse is for people who already have a reverse mortgage. The reason why is because once they get one, they forget everything they learned during their counseling session, and they want to know, hey, why did my interest rate change? Or, why am I getting this letter in the mail, the occupancy certificate? And so it answers all of the questions that people have after they get a reverse mortgage, including what happens when my spouse dies, or what happens if my home burns down to the ground, which was a very important chapter. I had written that chapter before the California wildfires. And so people started buying up this book like crazy to figure out, okay, now what happens? Well, it turns out the line of credit's not shut off. Okay, it's pledged money. It's a guaranteed loan. So no, it doesn't get shut off. So the safest loan you could have in California during a California wildfire is a home equity conversion mortgage. All right, moving on. All right, let's talk about some of the updates. So first, as interest rates drop, homeowners qualify for a little bit more money. Okay, so we just had last week, we had our lowest rates on reverse mortgages for the year over the last 12 months. And so we're offering the highest principal limits in a year. When rates go up, okay, they're unfortunately on Tuesday, rates are going to be a little bit higher than they were this week. And so our rates change once a week in the HECM world. And they take a weekly average of the 10-year CMT, and that if that goes up, then our interest rates go up. And so the amount of money you get is tied to the 10-year CMT and your lender margin. The amount of interest that accrues on your loan is tied to the 1-year CMT. So that's how we're able to offer rates under 6% right now. And yes, we are below conforming rates. Number two, there's been a shift away from FHA insured HECMs and toward proprietary reverse mortgages. And it's frustrating for me because I'm a HECM guy. I love the HECM product. I changed my career because of the HECM product. And so now we're working with HUD to make some changes to the program. I get to go to Washington, D.C. once a year to discuss my concerns. And sometimes they listen. So right now they're taking, they had a request for information. And so I'm submitting a lot of information that's collected over the last couple of years that I think the program could be better. But because of some of the weaknesses, there are products out there that exploit that weakness and start selling products instead of at 6% at 9%, but the client has no other option. And so just to give you an example, we're capped at $1,209,000 right now in property value for HECM. Okay, it's far cry from when it used to be county lending limits, right? In the 100s, 200s. Now we're at $1.2 million. So last month, we did a proprietary reverse mortgage for a $16 million property. Had we tried to do a HECM on that, the value would have been capped at $1.2 million. Well, the client has a $5 million loan to pay off, or he's got a bunch of loans to pay off. So ultimately, with a proprietary reverse mortgage, you're not capped by those lending limits. And so this guy was able to wipe out all the liens against a $16 million property, which saves him $30,000 a month in cash flow. So just know that there's a shift right now. 40% of the loans being originated today are proprietary reverse mortgages. Why? Well, maybe they're not yet 62. Proprietary start at age 55. What if it's an unapproved condo? FHA doesn't allow unapproved condos. Okay, well, if it's not FHA approved, then you have to do a proprietary. And what if it's 1.5 million or more? Then you're starting to look at proprietaries. So really anything over 1.2 million, you start looking at proprietaries. But there's a lot of reasons why this shift. I've only listed 3 of them there, but just know that if someone says proprietary, think that's not an FHA loan. That's not an FHA insured product. All right, now something that's I know near and dear to your heart is the one big beautiful bill. All right, well, let's talk about it, because one of the provisions of the one big beautiful bill is that beginning January 1st, paid mortgage insurance will be treated as mortgage interest. Have you guys talked about that one yet in your continuing ed? Yeah. Hey, great question from Amy. How to determine if a condo is approved? FHA has a site where you can go and see if it's an FHA approved condo, and it's less than 10% of them are approved. So that really hurts in the Florida market, some other, coastal areas. So yeah, we have to go proprietary, or we have to do what's called a single unit approval. It's not a spot approval, but it's kind of like that. It's a real hassle to get those through. So sometimes we just, throw our hands up and say, we're going to have to use a proprietary. Great question, Amy. So let's talk about the big, beautiful bill. Mortgage insurance is going to be treated as mortgage interest if it's paid. And you're thinking, wait a second, reverse mortgages don't have a payment. No, they don't have a required monthly principal and interest mortgage payment. All right, but can you make payments with a reverse mortgage? Absolutely. And I will, but I'm not going to do it every year. So what people are doing is they're stacking or pooling their deductions in years they want to itemize on their taxes. It's a brilliant strategy, because on a traditional or forward mortgage, you got to be making a payment every month. And so you're making small payments throughout the year. And by the time you get to the end of the year and get a 1098, it's not worth anything because the standard deduction is fairly high. Well, now people are saying, I'm going to get a reverse mortgage at age 62, and I'm not going to make any payments until I'm 66. And they make 4 years of payments all at once, and they get a 1098. And if that's acquisition indebtedness, then of course we can, we have all kinds of things we can do with you, right? Roth conversions. There's all kinds of things that we can do the moment a retiree has a massive 1098 potential deduction. One thing you probably need to know about this, guys, is with a reverse mortgage, mortgage insurance is paid back first. That's very important. It's written in the note, it's written in the loan agreement that when you decide to make a payment, okay, I want to make a $50,000 payment, it has to wipe out all of the upfront mortgage insurance and accrued mortgage insurance before it gets down to interest. Once you wipe out all the interest, then you start paying off principal that was originally borrowed at closing or in subsequent draws from the line of credit. It's called a servicing waterfall. The servicing waterfall says mortgage insurance gets paid back first. The easy way to remember that, guys, is the government always gets paid back first, right? If it's a government insured loan, they want their money, they're going to get paid back. And so mortgage insurance gets paid back. And so until this takes effect on January 1st, I'm not recommending anybody make a payment. Don't make a payment in 2025 because that first portion has to get cleared out until you get to the interest that you want. And so the moment we get to January 1st, people are going to start making payments on reverse mortgages a little more than they have in the past, simply because mortgage insurance is now treated as mortgage interest. And more on that a little bit later. I'm going to show you how that works. But let's open it up for any other questions. Does anyone have any questions they want to share? And I'm going to get this off the screen. I'm going to show my software. All right. Any questions before we move on? Are you excited? Excited to see what I've been working on for the last few years? All right. Well, let's go ahead and take a look at Reverse Plus software. This is called Analyzer Pro. This is a sales tool and technology that we've built to model reverse mortgages. And so I'm going to walk you through basically the way a loan originator explains it to the client or runs through a scenario. I'm going to create a scenario. So let's call him Roger. All right, why not? Okay, Roger, test case. So I'm just entering information about Roger in this case. I could put in his phone, I could put in his email address, and you'll notice that I have certain figures that are defaulted on the screen. For example, in my defaults, I'm in the state of Pennsylvania. My average client is 65, default home value of 500,000, and I have certain margins that I can stay within. My minimum, my default margin, and maximum margin. That's probably all you need to know about the settings, but maybe Roger's not 65. Let's say he's 70, and he has a $600,000 home. I can type in 600 and tab, and it's going to add the 3 zeros. And maybe he's got a $100,000 lien against his property. That's all the information I need to know about Roger to start running scenarios for Roger. Now, one of the cool things that we built into this software is we have a rate forecast tracker. Right now, this is an expected rate. This is not their interest rate. Their interest rate is closer to 6. But, and I could offer a lower margin and get that down. Let's go to a 2% margin. Okay, now I'm at 6.06. That figure determines how much money the client can get. I'm going to go back up to 2.5. Now, our forecast right here shows that rates next Tuesday, this same borrower, if I don't take an application and lock that in, their rate's going to be 6.63 on the expected rate, not their interest rate, but the long-term forecasted rate. Well, that's problematic because the client's going to lose $3,600. And if rates go up even more, they're going to lose $6,600 by not taking the application. So we actually forecast what the rates are next Tuesday. We do that with a little rate analysis. I know it's a small screen probably, but we track Monday, Tuesday, Wednesday, and Thursday, and we average them together. And when Friday comes in, then that rate is pending FHA approval. Okay, so right now we're selling a 2.5 margin with a 4.06 10-year. And next week it's going to be red, which means they're going to lose money. So probably more than you wanted on that screen, but it gives our loan originators a view of, well, what's happening next week, and should I hurry up and take an application before they lose that money? All right, now that's not the kind of thing you would want to show a client. So we have a little presentation mode, and it gets rid of all of my clients over here, and it has PowerPoint slide decks over here. If you're interested in what that looks like, let's talk about the financial planning implications. We can have a conversation with their advisor or CPA or financial planner. Hey, did you know that we can help mitigate sequence of returns risk? We can help with portfolio management. What about taxes? Just a quick conversation about how we can optimize their Social Security. We can fund long-term care insurance. We can either provide them the money to pay the premiums, or the reverse mortgage itself can become the premium. It can become the insurance policy. Remember that growing line of credit. We can help with divorce, silver divorce or gray divorce, relocation or home purchase. We can build an accessory dwelling unit. We can pay off other debts. We'll talk about that here in a moment, or establish a living legacy. Now, the client's going to forget those things the moment we tell them. 5 minutes later, they're going to forget. So we can add that to a PDF with a cover letter, some disclosures, and maybe we throw in a couple of those PowerPoints, which are condensed down to one-page resources. And we can add that to a PDF. It takes about 3 seconds, and boom, there you go. I now have a PDF to give the client. I can download it. I can email it. I can print it up. I can even view it, but I'm not going to do that yet. All right. This is where we really differentiate ourselves from other software that's been created to help out with the reverse mortgage. Most reverse mortgage software packages will try to condense it into a pie chart or a donut chart. They don't work with a reverse mortgage. So we have a $600,000 home value, of which I can provide the client $235,200 today with a reverse mortgage based on their rates. There are costs associated with it, and we have to pay off any liens, and then what's left over is left in the line of credit. The reason it doesn't work is because, let's say we have a $220,000 lien. Well, now they're short to close. How do you put a negative figure in a pie chart? It's very challenging to explain it to the client when there's a negative figure. But you can see that they're short. We can only give you $235,000, and when you add your costs and your liens together, it's more than that. In this case, an extra $8,500. All right, probably more than you wanted on that, so let's go ahead and move on. All right, this is going to be a refinance, excuse me, a refinance transaction. And I could increase the home's value over here, and you'll see that the home gets bigger and more majestic. Or I could reduce the home value. And every time I click these plus and minuses, all the figures on this screen change. This is what a reverse mortgage looks like. These figures right here, age 70, home value, margin, principal limit factors, which is like an LTV. I could put in $1.5 million and I could have a mansion, right? Well, then the figures are populated here for a mansion. I've encouraged our developer to put Christmas lights on there for the holidays. I actually wanted to decorate that for Halloween, but reverse mortgages should be fun. If you want to know what a starter home looks like in our system, it's our logo. It's our company logo. So everything's built on that branding. All right. I'm going to put in their current lien, $100,000, and they're making $1,800 payments for the next 7 years. That's their existing mortgage. Why is that important? Because we believe they should not be doing that. And we want to compare, well, what if you have your forward mortgage and we refinance into a reverse mortgage and you make the same payment? Are you better off? Yes, you are. And we'll model that here in a moment. I'm going to go ahead and move on from there, and let's talk about projections. We had a question. Is interest based on line of credit or an amount used? It's based on only the amount that's been borrowed. So great question. If I'm going to go back to this screen and my initial loan amount is 123, you're going to begin paying interest or accruing interest. You don't have to pay it, but you're going to accrue interest based on 123, not the amount that you qualify for, which is 235. It's a great question, Amy. Well done. Yep, only that which you've borrowed. So if I draw $100,000 the next year, okay, now I'm going to accrue a lot more interest. Yeah, great question. All right, now, up until now, we've been talking about one point in time, $600,000 home. I'm borrowing 123. I have a line of credit of 111. And the first thing you'll notice is, wait, my loan balance is going down. Why? That's not how a reverse mortgage works. Well, it could. If you make the same payment on a reverse mortgage, your loan balance will amortize in the same way it does on a traditional or forward mortgage. But there's one big difference. This massive green wave of liquidity. Okay, if you're taking notes, write that one down. The line of credit grows at the same rate as your loan balance. It's actually the interest rate plus 0.5%. So when you make a payment on a reverse mortgage, you get the benefit of this growing line of credit over time. And if I want to hover at age 85, my line of credit is worth $669,000, almost $670,000, guaranteed by the federal government, because I converted my forward mortgage to a reverse mortgage and made the same payments. Now, sometimes your client's going to say, hey, I don't want to keep making a payment. That's why I'm getting a reverse mortgage. Okay, well, if you feel comfortable with $1,800 right now and you're going to retire in 5 years, okay, stop making payments in 5 years. The reverse mortgage says you can stop making payments anytime you want. If you do that, though, then your loan balance is going to rise, but you still have this massive green wave of liquidity. You still have the line of credit. At this point, I like to go up to the home appreciation buttons up at the top. A lot of people are telling us, you know what, 4% is unreasonable. Well, that's what the government tells us to model, is 4% appreciation because it's a long-term average. But if property values are inflated right now and people are concerned, okay, well, let's drop this to 3. When I drop the appreciation to 3, you'll notice that there might come a time when I can draw more than the home is worth. Does FHA allow that? Yeah. That's part of the reverse mortgage insurance, right? Yes, you could conceivably draw more money than the home is worth. I can't tell you how many times I've sat at a kitchen table with a client and they've said, Dan, if you think this house is going to appreciate at all, you're insane. Sometimes I look at their house and I'm like, yeah, with your neighborhood, that might be true, right? But hey, why don't we model that? Well, you notice the line of credit doesn't care what your home is. The line of credit's going to continue to grow at the interest rate plus 0.5%, regardless of your property's value. That's a risk that FHA has to bear. And so you'll see that the line of credit continues to grow. And you know what? In 14 years, you could conceivably borrow more money than your home is worth. You could get here to age 94 on your deathbed and draw, you could draw well over $1 million. You could. People don't, but conceivably you could within the FHA program. Now let's bring this back up to 4%. But this becomes a hedge or an insurance against property value declines, right? Your borrowing capacity is not predicated on your home appreciating. Unlike traditional HELOCs, which are dangerous for seniors. Don't put seniors in a HELOC. Don't encourage that, because when property values decline, it gets wiped out. It happened to me in 2008. Anybody else have that problem in 2008? Did you lose your HELOC? I had a HELOC for literally 3 months and it was gone. It can't be taken away from you. It's not frozen, reduced, or eliminated. All right. Now, the client's going to look at this screen right here and say, well, of course my equity is going up. I'm making a payment. Well, let's kill the payment. Let's make no payments at all, which is generally what people do, right? Remember when I said it's not the reverse mortgage that erodes your home equity, it's draws. So within our software, we've created the ability to model, well, should I just take the growth from the line of credit each month? I could do that. And then eventually the accruals start to kick in and it really starts to dip. But my line of credit's unaffected by that, right? I still have, what was it, $111,000? Let's click on it. $111,000. And all I'm doing is taking the growth from the line of credit. All right, let's kill that. So I could take custom draws. I could take a single lump sum. For example, let's say I'm going to retire in 5 years and I want to buy a new car. Great, $50,000. In year 5, done. That's what happens to your reverse mortgage equity. And let's take a look at the amortization screen. All it did was cause your loan balance to go up and chew up some of your line of credit. Let's go ahead and kill that. And let's talk about LOC conversion for a moment. Let's go back and add the payment that we started with, matching their current mortgage payment, $1,800 for the next 7 years. Let's talk about LOC conversion. At any time in the reverse mortgage, you can take that growing line of credit and you can convert it into cash flow. Okay, you just flip the switch. You're basically annuitizing it, but let's take a look at it. LOC conversion. All right, so remember, at closing, I could take cash flow. I could get $737 every month as long as I occupy the home and the loan's in good standing. I could get $737 starting at year 70. But we've already established you're still working. You don't plan on retiring until 75. Well, at age 75, you can get $2,000 every month in perpetuity. Now, here's what the financial planners love, is they want to start planning for, hey, if I get to age 85 and I lose a spouse or I lose a pension or whatever it is, the cash flow that's coming in, can I replace that by flipping the switch and taking that growing line of credit and converting it into guaranteed monthly cash flow? I could, to the tune of $6,000. Okay, so at age 85, let's go to age 80. I could flip the switch. Maybe I lose my spouse and lose their Social Security or lose their pension, whatever it is, and suddenly I need cash flow. Okay, we'll just flip the switch. Now I'm getting an extra $3,600 in perpetuity. You'll notice that it accelerates up to age 95, and then the reason it slows down its growth is because it's calculated as if it's a rolling 5-year term. But you're going to continue to get the money even if you live past age 100. So can you imagine at age 95 getting $26,500 every month in perpetuity? If you have longevity in your family, that might be a good thing. All right. Now, some people don't qualify for long-term care. The reverse mortgage can be the policy. What I mean by that is one of the reasons I moved to Pennsylvania is because I have a parent with Alzheimer's. Okay, well, if I need care at that age, now she's 88, but if I need care, well, then I could get $16,000 every month for 5 years. Okay, so the orange lines are how much you could get every month. That's every month on the first of the month. It's wired to your bank account. Regardless of your property value, I could get $16,000 wired to my bank account the first of every month for 60 months. That's 5 years. Now, you'll notice that once you get to age 95, that option's gone. And that's because you'll get more money with a 10-year, which is a permanent payment. So it wouldn't make sense for you to go with a 5-year term, knowing if you live past that, you would rather have a 10-year. That's a 10-year is a permanent. All right, so there's some financial planning implications. All right, I'm going to get rid of this payment, and I'm going to talk about pooling or stacking your deductions. This is, I've got a buddy named Wade Pfau. Some of you may know him or know of him. Wade Pfau is the retirement researcher. He's a big fan of what we're doing with Reverse Plus. He's also on our advisory board now. He loves pooling and stacking deductions. Okay, let me take a look at this question. Your example of a spouse passing and needing to draw, what are the annual costs between now and when the draws start? Great question. There are no costs to the consumer to set this up for long-term care other than the accruals. So there's no out-of-pocket costs, but any amount that you've borrowed is going to accrue. Ideal situation, someone has $1 million house and owes nothing. Their minimum loan balance is $100. So technically the interest on $100 is all you're looking at. $20, Amy, $20 is the cost to flip the switch. The servicers have to do a little bit of work. It really literally takes them 10 minutes, but they charge $20 and HUD will not allow them to charge more than $20 to convert a growing line of credit into a tenure or a term. By the way, if you schedule a 7-year term and then that's not enough money and you go to a 4-year term, every time you make a change, it's $20 added to your loan balance. So again, it's not out of pocket. Everything is rolled into the loan. Great question, guys. All right. So what I'm going to do now is I'm going to do what Wade Pfau is talking about. Barry Sachs, others have thrown out this strategy where, hey, I want to make payments, but I don't want to pay any principal. I only want to pay things that might be deductible, potentially deductible. I can click on custom interest and MIP. And in this case, my loan balance rises for 3 years and then I make a payment. And it rises for 3 years and I make a payment. And so it goes through this. I accrue interest and then I pay it. I accrue interest and I pay it. And all I'm paying is mortgage insurance and mortgage interest to maximize my deduction. Now, for me, I'm not going to do it that way. I'm going to do it every 4 years. So I'm going to start in year 4. I'm going to end in year 12. And now I'm going to do it at age 62. So my first payment that I'll make on my reverse mortgage will be age 66. My next one will be age 70. And then by the time I get to my third payment, I'll have required minimum distributions. I'll probably make the payment from there. So if I click save, now you can see that my loan balance rises. I pay it. I can go to total payments made and show you that if you keep your forward mortgage, this is what you're doing. Steady payments until it's paid off. With a reverse mortgage, I made one payment and then another and then another. Why did I do that? Because the standard deduction is so stinking high, nobody's itemizing on their taxes anymore. So why not make payments every 4 years? And there's your 1098. So the reason Wade Pfau was impressed with the software is he said, no one's ever been able to model a 1098 that you would receive with a reverse mortgage, ever. I mean, it could be done with Excel. I'm sure somebody could figure it out. We had our Excel models 10 years ago on this. But the reason this is becoming more popular now is because as of January 1st, that orange gold portion up here, which for this borrower is $14,847, that gets paid back first, and that is now potentially deductible. So that's exciting for us to be able to do that. It's one of the driving forces behind us doing this software is to be able to work with CPAs and advisors to model, okay, well, what kind of payments do you want to make on a reverse mortgage? And clients are like, what do you mean? I don't have to make a payment. Well, that's true, But there may be cases you want to for the tax concerns, or every time you make a payment, your line of credit grows dollar for dollar. So let's take a look at the amortization, okay, or borrower's equity. Let's take a look at that. There's my line of credit. Boom, it jumps up. It jumps up every time I make that payment. Now I could get to age 95 and have $1 million line of credit guaranteed by the federal government. So Form 1098, by the way, I haven't been doing this all along, but I could actually click this button or this column right here, and I could add that to the PDF. So when I go to view the PDF, it's going to look like this. There's a cover sheet for Roger test case, age 70, $600,000 home. There's myself. That's a fictional NMLS ID. I don't originate loans anymore. But there's your disclosures. There's the financial planning use cases. That was a presentation that we went through with the client. What you should know about reverse mortgages. And then here is a snapshot of the pooling or stacking deduction strategy. Anything I want to save to the PDF, I can save. I can go to the amortization schedule and add that just by clicking this button. And it takes about 3 seconds, and there you go. So there's my PDF. And I can move that to the left, kind of like that. All right, let's clear the PDFs. All right, how are we doing on time-wise? I think we're doing all right. Let's see, we had a question. Okay, approximately 5 minutes. Okay, great. That's just enough time to talk about purchase. Oh, 25 left? Oh, then I've got more time. So Amy asked, to use for long-term care, I would avoid annual costs if minimum loan balance until cash needed. That's right. So I could pay it down to $100 and then stop. You don't want to pay a reverse mortgage below a $100 loan balance because the servicer can cancel your loan. So that's a warning that I put in my books. Both books have that warning. Under no circumstances should you ever pay a reverse mortgage down below $100. In fact, why even go near that? I would stick at $500. Because sometimes you get credits because of something that happens, property charge credit or whatever, and we don't want to mess with that. So why even get close to $100? You're not talking about a lot of carrying costs to keep this reverse mortgage going. All right. Now there's a lot more that we could put in here, but you know what? I'm going to move on to a purchase transaction, and let's talk about, let's say Roger went through the presentations with me and I talked to him about, maybe this isn't the right house for you. Maybe you should be living somewhere else. Maybe you should be closer to your kids and grandkids. Maybe you should be in a warmer climate. I recognize the appeal of that, right? Maybe you want to move back to Atlanta. But in any case, you can see automatically that Roger has $500,000 in equity. Now, I put round numbers in here. This is easy, 600 minus 100,000. But when Roger sells that house, he's not going to net 500, is he? So I'm going to click this over to a purchase transaction. If Roger has a $600,000 house, he's probably going to pay somewhere around 7% in real estate costs and transaction costs. Now, it averages somewhere around 6 or 7%. Some say it's higher than that. I had a for sale by owner transaction the other day. I was working with a loan originator, and they said, "Oh, we're not paying anything." Okay, great, zero, done. Now you are netting 500,000, right? So this is their current home. I also had a realtor that was a client, and I was working with the loan originator, and they said, "Hey, 7% doesn't make any sense because I'm listing it myself, and I'm only paying the buyer's agent 2.5. Done. So now I'm going to pay 2.5. That's $15,000, and I'm going to net $485,000. Now, when your clients decide, hey, I'm going to sell my house and I'm going to net 485. Mentally, they're thinking, I'm going to go buy a 485 in cash. And if you're taking notes, friends don't let friends buy a home in cash in retirement. They don't need to do that, right? Friends don't let friends buy a home in cash. Why would you do that? Well, because I don't want a mortgage payment. Well, with a reverse mortgage, you have no mortgage payment. So my software will show the agent, you know what? This client qualifies for $752,000 home. They can buy a $750,000 home and still have no monthly principal and interest mortgage payment simply by using the proceeds from the sale of their existing home. They can upsize. Now, sometimes they want to downsize. Sometimes they're like, well, I don't need a 485. In fact, I'm going to downsize to a 375 because I don't want to be in a 2-story home after a hip or knee surgery with 5 bedrooms, 2.5 baths on a full basement and 5 acres. I want to be in a smaller property, something a little more manageable, maybe a townhome or a condo. And I want a little bit more cash in retirement savings. If you bought a 375 after selling this home, I only need to come to closing with 245 because it's a reverse mortgage. And I'm going to keep almost $250,000. I'm going to hand that over to my financial advisor or CPA. And I'm going to say, hey, what do I do with this money, right? Should I be talking about annuities? Should I revisit my long-term care policy or life insurance, or what types of investment vehicles should I be looking at? That's $239,000. When you have a client that's downsizing to a $375,000 home, having $250,000 in your pocket, presumably tax-free, is actually a really big deal. Wouldn't you agree? Now, sometimes you start talking with the agent and they're like, okay, well, you qualify for 752, and they start looking at the houses and they're like, you know what? There's a house right down the street from my kids and grandkids. I'd really love to get that, but are they going to accept an offer of 752? No. In fact, it's probably going to be closer to 800,000. Okay. Well, let's see what would happen if I put 800,000 in this box right here. It tells me, okay, Roger, you're going to need to come up with an extra 30 grand. How are we going to do that? Okay. Well, you could sell the boat. You could sell the sports car. You could sell other real estate investments. Maybe you come into some inheritance. Maybe you've got a child that the child you want to be closer to, maybe they're going to gift you some money. Okay, well, there's 30 grand right there. And now you get a built-in babysitter because they're right down the street, right? That's a great deal. I'd pay $30,000 to have a free babysitter for the rest of that time. But then you could maybe say, hey, well, you could draw some of that from your retirement savings. I don't like to go that route. We want to protect your portfolio. But again, if someone really wants an $800,000 house after netting 485 and all they have to do is come up with an extra 30 grand, that's not a bad deal. Me personally, I've been working with a lot of active adult communities, 55 and over builders, and I would rather them keep more money in their pocket. You know, we have some that are 600 to 800,000 in active adult communities. I know they may be more than that, but let's zero this out. I would rather they buy a $600,000 home and have an extra $100,000 in their pocket. Why? Because once you're in an active adult community, the monthly dues can really hurt you. And so the condo dues or homeowners association dues can really eat away at that money. So I'd rather someone keep some of that money, presumably tax-free, because they've occupied that home. But again, this is how we view the reverse mortgage in our business. I'm going to show you one more scenario. And this is actually, this is our newest feature in the software. I don't have a home. Okay, you don't have a home. Why don't you have a home? Oh, because I sold it last year and I pocketed the money. It's been sitting in an account. I've been renting for a year until I find the house that I want. That's actually pretty common. When people sell their house and move, like my uncle did, my uncle sold his house and was able to net over $600,000 on his house in Florida. And he parked that money for a little while until he found the house that he wanted in Oklahoma. And by the way, he was able to pocket about $400,000 of that because it's a lot cheaper to live in Oklahoma. And so he was able to downsize from a price standpoint, but it's actually it's a much nicer house in a really nice neighborhood, more energy efficient, newer house, higher square footage. But he was able to pocket $400,000. Went to his advisors, started looking at annuities, changed his long-term care policy, his life insurance policy. He wound up investing a lot of it, and then had some play money. And he said, I've had financial peace for the first time in my life. I'm not going to have to worry about running out of money ever again, because he downsized something a little smaller. Okay. Keep going. He was able to buy somewhere in here, 475. Now, all he has to do is come to closing with 388. Oops, hold on. Let's zero that out. He had about 400,000 or 600,000 net. There you go. And he wanted to put it's about 250 down. There you go. He was able to pocket $350,000. Again, so this is a situation where if we go to the home, you'll notice that the refinance button's gone. You can't refinance something you don't own. If you put a 0 for property value, it's a purchase transaction. Okay, going back to the purchase. All right, let's see. One more thing. We've got time for one more. Let's do it. If I go back to the home screen, I'm going to put in the 600,000 again, just so that I have a refinance option. Sometimes it makes sense to sock away some of that money to pay property charges over my expected lifetime. Okay, so I'm going to go to, let's go to liens, make sure that's right. Yep, property charges. So in this situation, the client is paying $5,000 a year in real estate taxes. Those are annual, and $1,000 in hazard insurance. So HUD has their own calculation for how much we have to set aside if the lender is going to pay their property charges. Because the client's not making regular payments, they can't escrow like you have on a forward mortgage. They have to take the money up front. Now, to follow up with Amy's question earlier, are you paying interest on that $67,000? Nope, not until your taxes are paid and your loan balance goes up $5,000, or your insurance is paid and your loan balance goes up $1,000. So we can withhold $67,000 out of their proceeds that they could get just by clicking this button. It's the first software that's ever been created that can model what's called a life expectancy set aside. We're setting aside enough money to pay their property charges over their expected lifetime. Now, what's your expected lifetime? HUD uses 1979 female life expectancy tables. So it's not really a true life expectancy. But in this case, a 70-year-old, we use 15 years, right? So using that calculation, we can set aside $67,000. But remember when we talked about line of credit growth? That grows too. It's really a portion of your line of credit that you can't touch. So over the course of the next 15 years, actually 20 years in this case, we're expecting to pay $127,000 in taxes and insurance on your behalf because we set aside $67,000. Now, some clients have to have a LISA because they have poor credit or low residual income, and HUD requires us to set aside enough money to pay their property charges. Some of them should. We've had clients who have been duped by a Nigerian prince, not once, but twice. Well, then maybe you shouldn't have $111,000 in a line of credit. Let's lock up enough money to pay your property charges, because the worst thing that could happen to a reverse mortgage borrower, the only major risk that could happen to a reverse mortgage borrower, is they stop paying their property taxes. If they don't pay their property taxes, they're going to lose their house. Okay? Not because of the reverse mortgage, but because they didn't pay their property taxes. We're now preventing that from happening. Great question from Amy. Who has access to your tools? We just launched in the first week in October. And so we have people all across the country that use it. Right now, all of the loan originators at Movement Mortgage are using it. I know you have some Movement Mortgage loan originators in your market. There's actually quite a few of them in the Metro Atlanta area. But most of the reverse mortgage lenders are now aware of it. Now we're looking at enterprise solutions for a lot of major lenders. Brokers, we have not approached a ton of brokers, but they can subscribe if they want. We started with the National Reverse Mortgage Lenders Association conference and had a great conference. So they should have access to it or they know what it is if they're a NRMLA member. Okay. Yeah, and just reach out to me and I can tell you who in your market has it. So that's actually probably something we should put on a map eventually on our website, is just put pins where everybody's using the software. So great idea, Amy. Well done. All right. So setting aside $67,000 obviously reduces the amount I can keep in a line of credit. Okay, I'm now down to $40,000. But let's go over to our projections. And, I'm going to kill this payment here for a moment. And I'm going to take a look at taxes and insurance paid. At age 70, my life expectancy set aside, called ELISA, is $67,000. And as I begin to make property charge payments, that amount goes down. When that goes to zero at age 91, the borrower has to either pay their own property charges or the lender is going to take it out of their line of credit. If they don't pay their property tax bill, the lender has the right to take it out of their line of credit and pay the bill. And then their loan balance would go up by whatever amount. By the way, we're modeling a 1% inflation on property charges. And you might think, well, that's kind of low. Well, in many markets in the country, you can freeze your property taxes at certain ages. And so we could model, well, what happens if inflation is at 2%? What if it's at 3%? Well, then your lease is going to run out faster. What if it's at 4%? And so when we presented this software at the conference, loan servicers were there thinking, we don't have this technology. So this is something that maybe the servicers are going to use to model, hey, Mr. and Mrs. Smith, it looks like your LISA has 7 years left, and then you'll have to pay your own property charges, or it'll come out of your line of credit. And so that's actually a pretty cool tool. Okay, heaven forbid we see our property charges go up faster than that. That's like New Jersey over the last several years, right? All right. If we're at zero, yeah, we're probably gonna not outlive my life expectancy set aside. So, all right. I'm gonna reserve a couple minutes to answer any questions that you might have. In fact, I'm gonna go ahead and stop my sharing. Let me see if I can do that. I think that's it. All right. I think I'm stopping my sharing. Is that good? Oh, I see the group coming back on. All right. Did you guys follow me on that one? I know we went down a couple rabbit holes, but reverse mortgage has become very useful, especially for financial services professionals like yourselves. Okay. Any questions on reverse mortgages or any of the tax considerations, financial planning?
Absolutely. Building on prior times.
I didn't follow. Was there a question?
We have contact information.
Dan, can we get contact information on you?
Absolutely. Dan at reverseplus.com. That's simple enough, right? Dan at reverseplus.com.
Well, Dan, we want to thank you for coming in and taking care of us today on reverse mortgages. And
Sure.
we always appreciate your knowledge and your experience and look forward to the next time that we'll see you.
Absolutely. Hey, to answer Don's question, this year in 2025, we didn't have the software for these editions, but in subsequent editions, we are going to be putting some of the graphs and charts and strategies that we utilize. So if you have any questions, feel free to reach out to me at Dan at reverseplus.com. I can put you in contact with some loan originators in your market. Which companies do this type of mortgage? There's not a lot. And if they do, they're generally small divisions. So yeah, just reach out to me and I can let you know some of the ones in your market that actually offer reverse mortgages and are able to use my software. Hey guys, I wish I was there with you. Thanks for the invite though. And hopefully I'll see you next year.
Okay. Thank you, Dan.
Thank you. Bye-bye.